understand, and we're actually going to look at a stock again because we're going to look at some definitions on there based on what you see on the screen so you have a better understanding of what it is. All right, so dear Lord, we thank you for this opportunity to learn about our finances. We thank you for this opportunity to grow financially so that we can be a blessing here and abroad. Lord, we thank you that you have opened our eyes and our ears to discern and discover and to gain knowledge and wisdom according to your purpose for our life. We thank you that we have this opportunity to make a difference, and we look forward to the things that we're going to learn tonight. And we thank you for every home that is represented here. Lord, let whatever we learn here, let our financial picture be multiplied throughout generations so that it will go further. It is not just tonight, it is not just a dollar, but it is generational dollars. In Jesus' name we pray, amen. Amen. All right. So a couple of quick things that we're going to talk about right now is, I haven't put it up there yet, but have you guys ever heard of bear markets or bull markets? Have you guys ever heard those terms? Bear market or bull market? Okay. When people talking about the market is bullish or it's a bull market, that means stock prices or the market overall is on the rise or stocks have gone up. So when you hear people talking about it's a bull market, that means things are going up and things are happening and they're changing for the positive. When they talk about a bear market, that means things are declining. You didn't know that part, AJ? Okay, so bear market are on the decline. So kind of look at it kind of like the hibernating bear and yeah, bull and bear. And so when you're looking at things happening in your stock portfolio, you can have a bullish market or a bear market. And the reason you need to know those things, so when you're watching the financial news, when you hear something on the news that's financially related, and you pick up that word bullish, that means things are going up. So regardless of what you're investing in, more than likely it's having a positive effect. That's not a guarantee, but that is just saying overall the market is doing this. And they could just be talking about one particular sector. If they can say the technology sector is bullish while financial is bearish. So I don't know if there's ever that direct correlation, but just know that they could just be talking about industries or sectors or whatever being bearish or bullish. Got it? Easy enough? Yep. All right. So let me put this on here so you guys can see it. Is it up there? You got me, AJ? There we go. All right. Now I'm choosing SCHD. This is one of the things that I'm invested in. Like I said, it's a dividend equity fund. Everything in here is based on it paying a decent amount of dividends. I like this one very much. As you can see today, it went up 0.07. After hours, it went up 0.15. All right, so SCHD, which is what I normally know it as, is actually Schwab US. All right, Schwab, y'all know most of you have heard of Schwab, but Schwab US Dividend Equity. And so ETF, do you guys remember what that was?
I remember you saying ETF.
Can you figure it out for me? What is it, AJ? What is ETF? Equity traded fund, I think.
It's the group of.
It's a group. Well, just so you guys know, there are funds and then there are funds. But a lot of stuff, when they're talking about a fund, it's just a group of stocks lumped together. So you're buying that one thing instead of buying all 20 or 30 or whatever it is. All right, one of the things I wanted to go over is down here. Huh? Exchange traded fund. See, I was right. Did I say, no, I said equity, but that's okay. All right, so the one thing I want to talk about is expense ratio. So expense ratio is down here, is the 0.06%. Whenever you buy something, regardless of where you buy it from, if there's an expense ratio, you are paying a percentage of the expenses for that stock. All right, so this one is 0.06, and this means that the annual fee for whatever you're buying, that is that percentage, okay? So if this one, hold on, I touched the wrong thing. So if this one is based on whatever whatever the annual yield ends up being, you're paying 0.06% on that. Is that easy enough to understand? You good, Pastor? Okay. You figured out your problem? Okay. We'll look at it. All right. And so, so I just want you guys to understand that whenever you buy something, whenever you purchase a stock, this is what you're paying. Whether you're doing it as a mutual fund, whether you're doing it as a bond fund, there is normally an expense attached to it. All right? The expense ratio? No, usually it's pretty standard. It's pretty set for the duration. It's very seldom that it'll do a big jump. It's what the industry sets at, you know what, this is what it is. This is what you're going to pay for buying this. And if you look at where you're purchasing your stocks from, you should see that same number no matter where you're purchasing it from. So whether I'm purchasing it from Fidelity or E-Trade or Stash, it should always be that same number. No one should be asking for any more than what this number is when you look at it from a financial standpoint. Okay? You good? Okay. Now, one of the things I was talking to Michael about before we started, we were talking about the stash fund and the bank account. Like I said, I just want you guys to understand that that is an actual bank account that is covered by the FDIC. So it has the same protection as if you had a U.S. bank account, a Chase Bank, Rogue Valley, whatever it is. This is a real bank. I think it's actually supported by Green Dot, but it is an actual bank, and so you can do transfers in and out. You will have a routing number and you will have a bank account number. So if you want to use it for direct deposit or anything else, you have that capability. Okay. Huh? Oh, yes, and no overdraft fees, because once you run out of money, Stash is not going to let you use that card. It'll decline every time. So that is one great thing about it. All right, so we talked about expense ratios. We're going to kind of skip beta right now because it gets a little complicated. But year-to-date daily total return. So this is just telling you that it's kind of self-explanatory. The YTD, year-to-date daily total return. So it takes that whole year's worth of information and it breaks it down into a daily return is what it does. So this is telling you that is 4.16%. Does that make sense? So if you're looking at it, because what I want you guys to do after a certain point, once you get well versed in this, you're going to look at these things for when you get ready to buy your next stock. So when you decide that you want to be a bit more of a sophisticated investor, these are the different things you're going to look at. Like this one doesn't have a P&E ratio. But you're going to look at the expense ratio because if it gets into double digits, that might be something you may have set a limit on how much you want to spend on expenses. So if you see something that is the expense ratio is like 0.12 or something to that effect, that might be something that might be a no-go for you. So you start looking at those things and determining, is this something I want to invest in? The year-to-date daily total return, is that a decent enough return for you? What type of numbers are you looking for? So when you start looking for what type of things you want to invest in, like I said, you may decide that you just want to do tech stocks or you want to do real estate stocks or financial. But within those sectors or within those industries, you start looking at these numbers. This one has a yield of 3.16%. So that's based on dividends. So the dividend yield on this is 3.16%. That is an annual amount. This, just like if you had a bank savings account, it is what, 0.001%? All right, so this is 3.16. So this is a much better return overall as an annual dividend. Do you guys remember when I showed you my stash account last week? Do you guys remember what it was or how much I had? Kind of, was it still under $7,000? Do you guys kind of remember? It was at 7,000. I want to show you guys something. I know it's probably gonna. It's gonna make me do all this login stuff because it just gets crazy. Come on. There it goes. And trust to know is gonna, anybody trying to copy this is gonna reset itself, so I ain't even worried about what you're doing. All right, you see how much it went up? It was at 7,000 and just within a week made $118. This is why investing is important. And mind you, I haven't added any more money to this. My, let's see, where is it? My total return, 18.49% of what I put in there. This is the type of returns you get on investing. This is not the type of return you get on sticking money in a savings account for your kids, which is why I keep repeating, invest in your children, invest in your grandchildren. If you got too many of them, split it up a little bit. It's like, okay, it's the fun, and when it gets to a certain amount, y'all can split it up and do whatever you want to. But this is why we need to start investing in our children early, because of this type of return. Giving them like money to stick in a piggy bank or into a savings account is not going to offer them the growth that they can have. And then you can see my dollar change out of what I've done. My dollar change, I've made over $1,000. And mind you, I just started my investments in this account December of last year. Okay, so like I said, when I show you guys this, these are the things I will even show you right here. Hold on. These are the things I'm invested in and the type of returns that I've gotten. And I'm looking at my screen sideways while y'all looking at it straight ahead. But you see the growth on Microsoft since I bought it, it's up 32% since last December. And when we watched the video on the $5 cup of coffee, these are the type of returns he was talking about. But you can also see that Delicious Dividends is up 26%. All right. But you see my bond funds, they don't do so well. My bond fund is only up 2.79%. But the reason I invest in bond funds is because they pay monthly dividends. Microsoft and Delicious Dividends only pays me quarterly. So when you start looking at how you're going to, when you start looking at that whole diversification picture, it's not just about what industries or whether you go international or tech or whatever. There's also these aspects of it. It's like if you're going to invest in something that's paying a monthly dividend, especially if you're going to invest in a bond funds don't move as high and low all the time as a stock fund will. So, but you're looking at that because you want consistent payout. You want consistent dividends. You're trying to live off of the dividends every month. So like when you retire, you know how you get that monthly check? Well, your dividends can pay you every month as well. So I get decent dividends, but I don't get as much growth. So, and for me, that is good at my current age because I can't stand to lose a lot. Now, here's the caveat for investing. Don't invest what you can't afford to lose. Now, some people get upset because they invest $10 and by the time they look again, it's at $100. They think they can't afford to lose $100, but in actuality, they're only ever losing 10 because that's all they invested. But yes, it's still hard to lose, but I'm just letting you guys know to make sure that you have a realistic understanding of what you're doing and what you're investing in. Don't ever think that it's always going to go up. In the long picture, in the long stream of things, yes, the stock market is always going to go up. That's why people keep investing in it. But every day, dagnabbit, every day is not going to be a great day. All right. Okay, and just the quick thing down here, inception date. This is when this stock came into being, which is October 20th, 2011. And like I said, I'm just giving you guys some of the basic, easier stuff to understand. Some of the easier stuff to understand because maybe you want to know how long a stock has been around. If you're trying to get into stable companies, you may not want something that just, they just went, their IPO just happened a year or two ago. And IPO stands for initial public offering. All right? So IPOs usually happen, you know how when people make these apps and then they sell them and then they go public? That's an IPO. They decided that, you know what, instead of just making money off of selling the app, I want to sell shares of my company and get the equity on it. And that's when they become millionaires and billionaires and things like that. But I'm a firm believer in not investing in anything that hasn't been around at least as long as I know, but hasn't been around for a while. But certain older stocks like McDonald's or Pepsi and those type of companies, I wouldn't necessarily invest in them at this point because they're no longer growing. And depending on what they're paying out in dividends, it might not be worth it to me. So I don't invest in those companies. My husband does, but I do not. So like I said, you're going to have to get comfortable with how you want to invest and what you want to invest in. All right. Over here, I think we kind of touched on this last time. Previous close. The previous close on this was 66.82. When the market closed that day, this is what it closed at. And then it opened at 66.78. And that is because there is a difference between this and what we have up here, what was it? After hours trading. All right? So when you got, like I said, when you get to that sophisticated level, you might be with a company that allow you to do after hours trading. Okie doke. Is there anything else over here? The bid and the ask. You guys see the difference in the bid and the ask. The bid is 66.93, and that is if it's at this point. If you're buying these many shares, then that's what you get it at. But the ask is 67.05 at 1100. So I guess if it's under that, then this is what you pay for it. But more than likely, whenever you get ready to buy something, you're going to pay the ask price. Okay? Because yes.
Just back up for a second and let me know what so you got the 66.93
Yes.
times or whatever.
Yes.
What is the 31?
The 31, like I said, I will have to look it up, but I think the difference between the bid and the ask, I think it has to do with how many shares you're buying. I think if it's under a certain point, you get a different price than if it's above a certain point. Okay, and I'll look up that to make sure, because I don't want people to think I'm talking out of the side of my neck. But like I said, whatever you do, you're going to end up, whatever platform you buy it on, whether it's on Stash, whether it's on Fidelity, what's the newest one that's giving everybody problems? What's that? Robinhood, yes. All of these different ones, regardless of where you buy it, you're usually going to pay the ask, and you're going to pay it that price at the time of day. Depending on who you invest with, it could actually make a difference in what price you get as well. Because you may put in an offer to buy something at $67 a share, and because they took too long to buy it and now it's up again, so by the time you go and look, you're paying $67.50. Okay, you didn't plan to pay $67.50, you wanted to pay the $67. That's when, and this is not on here, that's when you put a limit on your investing. What a limit means is that if you're going to buy something, I want you to buy it at this price. And say if it's at $67.05, you want to buy it when it drops down to 67. So you put that limit in. You're telling it when it hits 67, go ahead and buy it. But as long as it stays above 67, I don't want any part of it. I don't want to buy it at the higher price. Okay? So that's when you put limits on it. All right. The days range was $66.43 to $67. That was the fluctuation for the day. So it didn't get any lower than the $66.43. It didn't get any higher than the $6,700. So that is your days range. The 52-week range. 52 weeks from year to date last year from this day last year to this day this year, the 52-week, the lowest the stock has been is $38.83. Imagine if you had bought it when it was $38.83, and now it's at $67. All right, that's almost doubling your money. And like I said, you can go back and see when that was, but this is,
Probably the end of March.
probably when everything dipped. And so this is just saying that lowest point within that year. It's not saying that it was at this point exactly 1 year ago. It's just saying in that 12-month period, there was a time where this is as low as it got. But this was probably when everybody else dipped, like you said, which was in March when they decided to shut everything down. All right, the volume. The volume is like how many shares are out there at any given time. No, actually, that's the average volume. How many shares are out there at any given time? And I think some of these numbers go into the billions or something like that. It gets really crazy. But these are shares that are traded over and over and over and buy, sell, sell, sell. When you see those trade market floors type deals, it's still all done with paper and it's all done with yelling. Nothing has really changed that I know of. I would probably have to go back and watch a new movie or do some research. But that is how they operate. All right, and I think that's all I kind of want to do. But you see the net assets on this? The net assets is 16.3 billion. So y'all own a piece of that when you buy this. You don't have the billion part yet, but you could probably make it to some hundreds and some thousands. But this is the net assets on this. Okay? Now, like I said, right now we're looking at the summary. Excuse me. And we've looked at the different aspects of the chart. When you're deciding on what you want to buy, you will see some charts that don't look like this. This is showing you that there's a steady increase over the last 5 years, except when it dipped in March. You see that big dip in March, and we all know when that was. But it came back, and it rose higher than it was even before the dip. You see that? So you may, like I said, you may look at bond funds. Bond funds don't have this type of increase normally because they're bond funds. You're loaning them money. A bond is basically a loan, whereas stocks are equity. Thank you so much, Pastor. I appreciate that. Where that's equity. So you're loaning money versus actually owning a piece of the company. Oh, thank you. And like I said, I'll get into some of these others down here, but I want to give you a better explanation. And I actually was going to make slides for you guys, and I didn't do that because I wanted to be able to answer any questions you had when they came up. So we'll get into the NAV and the P&E ratio, but this one doesn't have it. And then, like I said, we'll also get into the beta. The beta is a little more involved in some things. But let's see what they have in the charts. Okay, you guys see this chart right here? I'm trying to make sure I got it smaller. But these are what people look at when people talk about being financial analysts. Just so you guys know, you cannot predict the market. There is no way, no how, nobody can do it. What they give you is a financial analysis. That's why they're a financial analyst. What they're telling you is based on trends. And as you invest, as you become a more sophisticated investor, you're going to look at trends. And you're going to be able to know, based on how you invest, what trends you want to follow. Based on what you want to invest in will determine what trends you want to follow. So don't ever get so stuck on what they tell you, like based on these, and you see the ups and downs and the negatives and the negative and the positive. And like I said, I don't want to... But all of these down here these are just things that people look at to tell you what they think is going to happen. But you see they had these big dips in and out of here. When you're talking to a financial advisor is not a financial analyst. A financial advisor is usually trying to sell you a product. So he wants you to buy something that he's selling. He is not an analyst. He can't really, with any certainty, tell you that, you know what, this is what you should get in because. He can tell you what the trends are or what's going on because they are more knowledgeable in that area, but they are not a financial analyst. They do not have the necessary background to tell you all of that. It's just, you guys heard of Edward Jones? Okay, Edward Jones offices, they only have one person in every office. That person is basically a franchisee within that office. And the only thing you can buy from Edward Jones is Edward Jones Mutual Funds. They may have something similar to Schwab like SCHD, but they just have it by a different name. But they have all of their own things. And so that one person in there is a financial advisor. They are not a financial analyst. They are selling the Edward Jones products, and they have their own expense ratios. So, normally they should be whatever this is. I haven't dealt with Edward Jones in a really, really long time, so I can't say for certain, but expense ratio should be the same across the board. All right, let's see, where did the other part go? Okay, when you're investing, you also want to look at what people are saying, not necessarily just any Joe Schmo off the street, but you want to look at the conversations that are going on, because sometimes these conversations can have an effect. It says, and these people, this was just, somebody just posted 10 hours ago, just started a position in this yesterday. I've been a Vanguard investor for 18 years, which has been great, but there's ETFs, their ETFs have gotten so expensive, that expense ratio. So this is letting you know that somebody actually decided to pick this because they thought it was cheaper. SCH is doing better than both of Vanguard's dividend ETFs. Same low expense ratio, great picks for the top holdings, plan to keep adding on any dips. So that's letting you know that this type of stuff, when you're looking at conversations and you're looking at what people are talking about, it can help you form the decisions of what you want to invest in. Certain things, don't get so caught up on what's the word I'm looking for? I wouldn't necessarily say get so caught up on research that you don't pull the trigger, but you can take these and use them as a way to gain, like, okay, am I the only one thinking this kind of deal? That makes sense? So when you decide that you want to buy Google, okay, yes, we all know Google's a great company. Google just did, they just did a rebrand. Y'all know I do branding stuff, but they just did a rebrand. A lot of people were upset about the new icons. They did not like them, but that is what they decided to do. And so that was a conversation, but even though that was a conversation within this, I don't think anybody really lost any sleep over it. They just didn't like it. And the thing about it is that conversation is happening because when Google rebranded, part of their thing was they were adding on their whole workspace platform. They're trying to create this whole thing where, you know what, you don't have to leave Google to do anything. They're trying to capture the work from home force. So if you know you're part of that kind of work life, you may choose that's why you want to invest in Google, because you know that they're coming out with new products that are going to make work from home a whole lot easier. If you see that as being an uptick trend that people are going to go to, then that may be something you want to look at. So conversations like this person, what's the yield? That don't mean a daggone thing to you. But like I say, just look at what people are saying about the things that you want to invest in and see if you hear anything bad, because they may be talking about stuff, not necessarily from an insider trading kind of thing, but they may have some insight that you don't of why they're doing this, or they may have been trading for a lot longer than you have and help you make a better decision. All right. Historical data. Historical data can go back, I think this one is based on a year. But this historical data is showing you for SCHD is showing you the date, the open rate for that day, the high, the low, and what it closed at. It's telling you that the average close is 689, and it's telling you what the volume was for that day. So there was 1.3 million trades that day. All right, I want to go down to, see if it's any, okay. It's showing you that on December 10th, they paid 0.602 cents per share in dividends. So if you had 10 shares, of this, you would have got, what, $6.02? And that's what you would have gotten on December 10th. And you can go all the way down and see what they paid every quarter. The quarter before that, they paid 0.543. Before that, 0.442. So you see that it has been going up steadily. Where is the other one? The other one for the year? Before that, it was still 0.442. So their dividend has increased within the year. And so if you own 10 shares at the beginning, if you own 10 shares on March 25th, 2020, this is what you got. You got $4.42. If you own 10 more shares at that same time, you still would have got $4.42. But then if you held on to that same 10 shares, but the thing about it, if you're reinvesting your dividends, it's going to take that $4.42 and buy another little piece of that particular fund. All of my stuff is reinvested at this point. I'm not getting enough out of it to make it worth my while to pull it out. So, like I say, so when it goes back, when you started out with that those 10 shares, when it took that $4.42 and bought more shares, so now say you have 10.02 shares. So now you're getting more money off of that. And then when it pays you that next dividend, now you're at 0.02. So now say you're at 10.05. Because every time you're taking it and you're reinvesting it into your back into the fund that you're purchasing. So every time it reinvests, you own a little bit more. Until you decide, you know what, it's paying enough now because you have enough shares. Say like you have 100 shares, so now you're getting $40 a month. And okay, $40 a month may work for you. You just needed some lunch money. So you still have your principal, which is still making you $40 a share or $40 a month, but now you have $40 in your hand instead of having it reinvested. So that's what this looks like. So when you want to go back and actually see the numbers, you're going to go into the historical data and look at what the market has done. When you want to see where those highs and lows hit, and part of, like I say, when you get to that whole sophisticated investor part, you might see a certain trend that certain people don't notice. You might notice that every April, something happens. It goes down 10% or something. And you may read the news and find out why that is. Okay, every April they do a vote on something that just makes the market dip a little bit. It usually recovers, but you may decide that every time that trend happens, every time that little dip happens, you want to buy a little more because you can get it cheaper. You know it's coming, so you want to buy it cheaper. And you know you're going to make money like maybe the next week off of what you just bought. And there are people that do that when you start talking about day trading and so forth. You decide, you know what, I'm going to buy it today because I know they're going to do this dip down and then it's going to come back, so I'm going to make me an extra $100 and I'm going to sell it off. There are people that do that based on, there's a guy, he does it in $1,000 increments. He buys something for $1,000, it hits some peak, and he makes $500 in a day. And he sells it all off, he takes that $500 and he rolls it over and he does it again. There are people that do that. Y'all smart enough to do it, y'all go ahead. I don't have the wherewithal to try and make it, but it's great money. So if y'all ever get that sophisticated, let me go. No, I got 5 on it. Okay, so this is the profile. Morningstar is just like a tracking, I wouldn't call it a tracking. A lot of analysts go to Morningstar to get their information, just put it that way. But what this is showing you that this Schwab U.S. Dividend Fund is large and it has value. And this is based on this investment valuation. Is this too much for you guys? Am I giving you too much? You guys okay? You okay, Michael? Okay. McDonald's is kicking butt, huh?
No, they're not. But I'm just saying McDonald's moved from their old building and built a new building.
Yes.
Then Kentucky Fried Chicken
did the same thing.
Old building and built another building. But I'm just saying since the pandemic.
Here it is. This is McDonald's.
Yeah, big businesses are doing that.
Mm-hmm.
It ain't been a year next month. It will be a year since the pandemic.
Mm-hmm.
Is so much construction.
Yes.
I
But it's all fast food. What does that tell you? Should you be investing? I said, but it's all fast food. So should that tell you you should be investing in fast food based on where we live? Who owns these big companies? McDonald's is right here. McDonald's has gone up, went up 4% today. I'm not, when I say it's not growing, I'm saying it's not growing at the extent of when it first started.
It's so many different, you know, you got, what, is 5 something, you got so many hamburger in, I mean, Burger King, like y'all just.
Yeah.
Burger King, I think they got, you know, they still the dollar, and you ain't getting
Yep.
in years, but you know, just amazing since the pandemic, how these big, huge companies
Yeah.
just go.
They're popping up all over the place.
And it's mostly through the drive-in.
Yes. And see, and like right now, because what's happening with like, say with McDonald's, Starbucks, all these different ones, because what, 4 or 5 Starbucks have gone up since? Yeah. Okay. So what, when they talk about these on financial news, what they'll tell you is like, based on store to store or based on, when they're talking about store to store numbers, it's like, okay, these stores in this region may have done something, but these stores over here didn't meet the goal. So if they're doing a forecast of a 5% increase, then is that enough for you to make you want to invest? Or they may say our second quarter projections aren't what we thought they'd be. We predicted a 10% and we only got 2. So then what does that mean? Does that mean you still go? And that's the thing. You have to make up your mind how you're going to do this, because if they're saying that we projected 10 but we only got 2, does that mean you can go and buy Starbucks for cheap and then hold it? Because there will be some financial analysts that will tell you to buy and hold. Just hold on to it because it's going to come back. They're going to hit that 10% mark and exceed it. Like I said, when I got mad at Starbucks, I threw my card in the trash. I sold my stocks, everything. I was hot. But Morgan still held on to hers. And so when I saw all the Starbucks going up, and like I said, Morgan is doing very nicely with Starbucks. Me, I was just mad. But it was the principle. Excuse me. It was the principle for me. I'm not mad that I'm missing out, because trust me, I invested in something else. That's the only thing. I just chose a different place to place my money. But Starbucks is doing very well, because they had gotten down to, I think, $60 a share, and I don't even know what they are right now. But I know I think they're, well, heck, we can look it up. But like I say, this is McDonald's. McDonald's has gone up 4%. And like I say, a lot of these companies like McDonald's and Wendy's and so forth, they're doing great, because this is all that people can get. So their store sales, their revenues are showing that, you know what, we're kicking butt. But when the pandemic is over and people can go back to sitting down somewhere, will they still be kicking butt?
And plus, they don't have as many employees, no more. I'm talking about what work, you know, what's working here.
Uh-huh.
That's something, like I said, I see too, you know, like most owners will tell you that they don't cut back since the pandemic. And like I said, I'm just using McDonald's and Burger, McDonald's and Kentucky Fried Chicken, because I just see, you know, just a few people there, and, you know, like I said, it's mostly drivers, but I think people still are going in order, but they can't sit down like you
Yeah.
say, so you don't need as many employees, so the overhead is cheap.
Is less. Yes, overhead is less. Yeah. And if you looked at it from a standpoint, if you look down at not the Medford Shopping Center, whatever that shopping center is right there on Biddle and McAndrews. Okay, you have Carl's Jr., Wendy's, okay, Carl's Jr., Wendy's, and McDonald's. Based on just what you see on those lines, which one would you invest in? There you go. McDonald's drive-through, their line will come out and go, yes. But you go past Carl's Jr., they got 2 people working in there, and they're doing good if they sit in 6 cars deep on a good day. And like I said, Wendy's is doing better than Carl's Jr. And all of them are doing better than Burger King, and Burger King is not even in the neighborhood. But if you, like I said, if you use that as part of of why you invest in something, because you decided you wanted to invest in fast food, That's your version of an analysis. I know what's coming through here. And I live in this small town, so imagine what's going on in big cities. That's why McDonald's is up 4.4%. Okay, let's look at, where is it? Let's look.
Starbucks is about 106 per share right now.
See, and Morgan held on to hers when she bought it at 70 something. So she made, what, $30, $30 or $40 a share? And then plus she's gotten the dividends since she's held on to it. So like I said, your reasons for investing can vary. But I wanted to look at their historical. All right. Now here, this is a reason for somebody to buy McDonald's. Look at how much they paid in dividends. We were talking about SCHD was 0.602. McDonald's paid out $1.29. So for every share you had, if you had 100 shares, you got $100.29.
Yeah, they're at 215.98
Whereas with the other one, you would have gotten half that. So if dividend is your strategy for increasing your wealth, yeah, here, I think we had it up here. Yeah, 215.98 went up 4% today. And then in after hours, it went up another 0.02%. But like, Costco went down. See, and then in August, they paid a dividend of $1.25. May, $1.25. And February, $1.25. So they went up 4 cents just this past quarter. So like I say, if you're looking, even if you're not looking for growth, but you're looking for income, this is income. This is your money working for you. You know what? Go out and make me some babies and bring home some more money. That's what you're doing. You're sending your money out to multiply when you invest. And this is why you choose these type of things. Like I said, me personally, I don't invest in growth stocks. If it's not paying me a dividend, I don't want it. That's just my own personal investment thing. But there are people, what you need, sweetie?
Margaret, the mic for the audience, because Michael asked questions and she didn't know what your answers were.
Oh, okay. Michael didn't, I don't think he necessarily asked the question. I think he was just,
Making a comment.
yeah, just making a comment. You gonna make me do Mike?
Yeah. Number
Whoever
3,
has a question, they
Okay, all right,
mic, that way it goes across.
okay.
What your answer
number
is.
3.
You bringing it up? Okay,
Check.
okay.
All right.
All right, now here's something else.
If you have a question, that way they hear it across.
Yeah, because Michael fusses at, not you, Michael, but the other Michael, Michael Lee fusses at me. I don't know what the question was. Well, that's why you should be here instead of out driving trucks.
He is listening, he said he would listen.
Yeah. Okay, now here's something that you guys should know as well. Because like I say, some people invest based on different information. You can go in and look at a company's profile. Okay, it gives you their corporate address, but what they also tell you, the key executives, look at this. The president and CEO director, look how much he made.
How much money he made?
$2.73 million.
Buy McDonald's.
What, a year? Is that
No, this is not him owning a McDonald's. This is him being the CEO of the McDonald's.
So, and that's annually.
That's annually.
And this is, because McDonald's, they're franchises, right?
Yes.
So that's annually, right?
That is
And
annual.
Because McDonald's is a franchise?
Not all of them are franchise. Some of them are still company owned.
Oh, okay. So this person is CEO over,
Over the McDonald's Corporation.
okay.
Yes.
So, so the franchises are under his umbrella.
The franchises and the company-owned ones are all under him, yes.
Okay.
Everything that happens with McDonald's, he's the top of the heap.
Yeah.
Okay, he's the go-to. Okay, so he's making, he's paid 2.73, and it looks like he has an exercise option of 2.32 million. So if you wanted to go look this person up, and you find out he's doing something shady, okay, you see how much McDonald's pays, or you see how much they've gone up, you see what their dividends are. Would his shadiness cause you not to invest in McDonald's? Yes. So, and you see how much these people make based on you being a retail investor. You can only afford to invest $10 a week or whatever it is, and this dude is still making 2.73 million. Do you want to invest in McDonald's? These are things that people make decisions on, or how they choose to invest. So, and these are the key executives. All the people, you see how much they're paying out. And then when they got to the executive level, and then you can also see how old these people are. This dude was born in '69. So how much longer is he going to be in charge? Because you can go further in and find out how long he's been at McDonald's and see what the growth is of McDonald's up under him. If McDonald's has been going down since he's been in charge, you might not want to invest in that, because there's something going on that this man is making stock prices go down. And trust to know, they will get rid of him. So when you're reading financial news and you're seeing that either people are being resigned or being let go, there's a reason. They're not doing their part, because at the end of the day, it's not about how much the McDonald's store sells. It's about how much you're making your investors. If the investors aren't happy, trust me, nobody's happy. Bless you. All right. So so like I said, you're looking here at the top people within McDonald's. You see their titles. Like this person right here, the interim general counsel and secretary. Okay, will they make him? Will they ever actually hire him or give him the position permanently? And if he does, will that affect stock prices? It can, and it may or it may not. But these are the things that you look at. Like I say, the more sophisticated you become, you might go and see that these people are, if you're not a Trump fan and you find out that most of these folks is friends with Trump, would you still buy McDonald's? Like I said, these are things you have to think about. If you're considering yourself a socially conscious investor, then you're going to invest socially consciously. If you're deciding that you're going to invest in green, and by green, I mean in eco-friendly products and services, then would McDonald's even make that list? If you find out your green company is part of McDonald's, under McDonald's portfolio over here, do you still invest in it? Because some of this stuff is so intertwined, you can't get out of it. P&G is so deep in all of our houses. You guys, is P&G? Yeah, the Unilever and the Nabisco and the Nestle, all of that falls under them.
Johnson & Johnson is another one.
Yes. Yes. Yes.
Okay, this is the question, personally, probably for me, but like you just said, that I can go in and I can find out how old this guy is and everything else. And I know myself, some black peoples in Atlanta bought a lot of land and they trying to do all this. So when I go in there, would it tell me the person's race?
No.
No. Okay.
But more than likely, if you Google him, you'll find his picture and you'll already know.
Okay.
Yeah.
All right, thanks.
Yes. So when you're, like I say, so when you're deciding on what companies to invest in, all of these may be factors to you. So some people just like, oh, they're making money, this is what I'll buy. There are people on Facebook group, in stock groups saying, you know what, this is going up, you need to go buy some. And so if you're just basing your decisions on what other people are saying, then that is how you're investing, and I think that's pretty dumb. That's just my own personal opinion. Let's look at financials. Now, I'm not going to get all off into this, but I just want you guys to see the financials for McDonald's. This is their breakdown. Their total revenue at the end of 2020, $19,207,800. All right? But look at what it was in 2019 and 2018. $21,076,500. Yes. You have your cost of revenue. The cost of revenue is pretty consistent, but the overall total revenue still went down because you still have what's the word I'm looking for? You have set overhead costs versus variable overhead costs, and so some things are just not going to change. But their gross profits, look what their gross profits for 2019. 11,115,000. And this may even be in billions because sometimes they leave off a zero. But that's what they're showing for that whole year. And I know there has to be more, this has to be missing a zero because my friend owns a couple of McDonald's and I know he makes a few million himself. Yeah. I'm thinking this is missing zeros, which is fine. Yeah. And so, like I said, this is showing you their gross profits. You're seeing that their gross in thousands?
It says right at the top. Scroll just a little bit.
Oh yeah, okay. So we're missing a couple of zeros. We're missing a few zeros. Okay, but you're seeing that how much money they've lost in just a year because of the pandemic. So even though we see these long lines, they've lost a lot of money. All right, and then so you have their gross profit, you have their operating expense. Their operating expense went up from what it was in 2020, even though their income went down. You guys see that? So that we have the 2,229,000 and it went up to 2,255,545. So it went up. Their operating income went down. Pre-tax income went down. And I'm down here I'm on this one right here. Their pre-tax went down. But all of this should play a part in why you choose companies. It's not as simple as just looking at what's going up. People just look at charts and say, you know what? Ooh, they're going up. They don't know why they're going up. It could be a short-term increase. Like I said, McDonald's is still going up, but you see they lost money. Their stock price still goes up, even though they're losing millions of dollars. All right, bottom, let's get down here. EBT, their total expenses, right here, not much difference from 2019 to 2020. 12,190,000 in 2019, 12,100,300. So it didn't change much. Their total expenses. So not only are they losing money, but their expenses are staying still. So you know they're not making as much. But the stock price is still going up. See, it doesn't make sense, does it? People are still buying McDonald's stock, even though they're losing money and their expenses are the same. Let's jump down here to the bottom. Let's see. Tax effect of unusual items, 644. Yeah, let me look this one up because I kind of think I know, but I want to look it up just to make tax effective unusual items. Because for it to drop that considerably, let's see what that means. Unusual items. Does that make sense to you? Here, let's put it, hold on.
So when it says shares outstanding, those are shares that have not been bought yet? Yeah?
No, those, you know what, let me, because shares. And that's why I say some, I know some stuff, I don't know everything. I just want to make sure I give you guys the right answer. Shares outstanding refer to a company stock currently held by all its shareholders. So yeah, I was right, what I was thinking. This is what everybody else holds. So shares outstanding is what we all own right now. Okay, if they're not outstanding, they haven't been bought yet. But let's see. So the impact of that whole unusual thing, unusual items, go away, why are you here? Okay. So unusual items affect the net income calculation on the income statement, including resulting in a loss. For example, a fire that destroys a small company's production facilities could result in a net loss because the company would have to repurchase inventory, repair damages to the building, and buy or lease new equipment. For public companies, unusual items also affect earnings per share, which is the net income divided by the number of shares outstanding. I know, and that's why I say some stuff I don't really, I get it and I understand it, but it's kind of a challenge to explain. But the thing about it is, it dropped considerably. Look at it. On unusual items, they usually pay 19, and like I say, it's missing some zeros, but they usually pay about, say, close to 20,000. Whereas now they're only paying 645. So what did they get rid of? Or what happened that they don't have to pay nearly as much? Is it because the overall stock price went up and certain things went down? You'd have to dig a little deeper. And this may be a cause of concern for some people. And this is why sometimes when you're looking at corporate investors or companies that invest, like I say, we're retail investors. Individual people are retail investors. And there's only about 25% of us who own that piece. But then the corporations that own this, if you see them talking about stuff like this, or you see them selling off, if you see a company or some like, well, if we go back and we look at those people that are executives in this company, if you see news that they're starting to sell off their McDonald's stock, something is crazy, something is stinky. And you need to check and see, do you need to go ahead and sell off your own? But sometimes, like they were trying to do with GameStop, they're trying to drive prices down so everybody else will sell so they can go back and buy it cheap. So there's all kind of shadiness going on. So you do have to read the financial section of the paper, at least the parts that pertain to the stocks that you're invested in. Make sense? Like I said, I make Morgan read certain parts of Microsoft and Starbucks and different things because they show up on her, when she's doing her E-Trade, it shows the daily news for certain things that are happening with her stocks. So yeah, she has to go in and read it and make sure that, you know what? When she wanted to buy more Nike, why are you buying more Nike? Look at what's going on. And she looked, okay, she said, well, maybe I won't buy any more right now. So keep up, when you start investing in things, like I say, Schwab is an index fund, true enough, or not an, excuse me. Yeah, Schwab is an index fund. It has all of these different dividend funds in it. But if there's something that comes up about Schwab, you might want to check it out. You can make Google alerts on your phone to tell you like, okay, they're talking about McDonald's. Let me see what they're talking about. And see if it's something that's going to affect your stock price. If you start to see drastic drops in your stock, you might want to check the news. It might be a reason for you to jump ship. It might not. It might be a reason for you to go in and buy up everybody's stuff when they're dropping down and you can get it for cheap.
Get your Starbucks.
You know what? I'm trying to make myself go back and buy Starbucks, but I just ain't there yet. That whole thing just kind of chaps my butt. Yeah, it's because, like I said, you said it, you meant it, you just took it back because you knew you were going to lose money. That's the only reason you took it back, and that just does not sit well with me. But anything that you're considering investing in, like I said, I use Yahoo Finance because they have a lot of information on here. You can use any type of financial website. If you want to learn more terms, and I will come back and talk about more terms, but some of the more complicated ones, I wanted to get through some of the easy ones because I knew I can kind of cover those in an hour. But the more complicated ones, these have to do with how they calculate certain things. And because I don't really want to do the math, that's why I didn't kind of go into those. Because then we need a chalkboard, a whiteboard, and I need to have something to drink too. Just to get through it, I was like, ooh, I'm making my head hurt. But I do want you guys to have a better understanding, and I hope I'm making you guys comfortable with this. Because like I said, you guys are now, if you've opened your accounts, you are investors. And you need to know how to talk you need to know how to talk money. And it's not that you're going to learn to talk it all in one day. I don't talk it nearly as much as I used to because I took personal finance when I went to school. But that does not stop me from making sure that I understand it. If you ever try to read a prospectus, oh, that's going to make your head hurt. I'm sorry. I'm just going to tell y'all now. Because whatever you buy, you're going to get a prospectus. It's going to be in tiny, tiny print on very flimsy paper if they send you the book in the mail, and it can be hundreds of pages long. And they will go into great detail about every cent that's on that. Oh, it's mind-numbing. But I wanted to show you guys this right quick. This is an analysis report. So your earnings estimate is telling you the number of analysts that looked at this. That whole top number. So for the current quarter, the next quarter, current year, next year. So they had 30 for the current quarter and 30 for the next quarter. And then the current year, overall, there was 36. And for next year, there's going to be 34. And so the average estimate, what is this? So they're talking about earnings per share. This is something else we're going to have to get into later. But they're showing you what their average estimate of whether it's going up or down and those type of things. So this is the earnings estimate. They're estimating that it's going to go up by these small percentages.
And that's coming from the analyst.
This is coming from the analysts. This is based on 30 analysts, and I guess these are the averages for it. So they have a low estimate and a high estimate, and then they give you the average. And then this is the year average of the EPS, which is earnings per share. All right. And then they also have are we still at McDonald's? I think we're still at McDonald's, yes. Okay, and then they have the revenue estimate. So they're, for this quarter, March 2021, they're estimating $5.02 billion. For next quarter, they expect it to go up to $5.41 billion. Yes, for the current year, $22.05 billion, just at McDonald's. Just at McDonald's. All right, so the low estimate, you see what the low estimate is for the current quarter, the next quarter, the year, and the next year. So they're expecting a sales growth this quarter of 6.4%. Now, if they don't meet that, when the report actually comes out, they'll tell you if they met it or not. And like I said, if you decide to make a move based on that factor, or you decide to hold on to it, because it may not make that 6.4, or it may even exceed the 6.4. But they're telling you that they're expecting it to go, because if they didn't, these will be negative numbers. So they're still expecting growth for McDonald's. All right? And then they're expecting a current year growth in 2021. They're expecting it to go up to 14.8%. I might buy me some McDonald's. I don't necessarily eat it, but hey, doesn't mean I can't own it. All right? So like I said, we're going to talk about earnings per share, the EPS of it all. We'll talk about that at a later date because, like I say, it might require a little bit of math. But it gives you that information, the earnings per share trend. So over 7 days, 30 days, 60 days, and 90 days. The revisions are down here, 730, 7 days, up the last 7 days, up the last 30 days, down the last 7, down the last 30. So like I say, when we get into all of that, you guys, it'll make a little more sense. And then these are the growth estimates. Look at next quarter, 206.10%. So, yeah, that's what they're expecting next quarter. That's the growth estimate of McDonald's. And they didn't even include the industry expectations. They just included McDonald's. You see that? So it makes you wonder, should you buy McDonald's? Would you guys invest in McDonald's now? With the little bit of knowledge that you gained tonight? Huh? You want to get closer and see?
No,
Okay.
no, because I don't know if people can hear me, but these analysts is almost like playing sports. No, like,
Yes.
like the weatherman.
Yes.
You know, that's all I'm saying. And I'm not knocking none of these analysts. But I know, like you said, this is what they project.
Yes.
But who knows? Because a lot of these guys, they project not a lot, but some of them project stuff, and it's not. But like you always said about investing, it is a gamble, but that's
This is how you make better decisions.
better
Yes.
decisions, because like I said, I ain't got nothing against McDonald's, but one thing I do know, like the McDonald's in Medford, when they moved over to that other spot, they don't own that land. So they leasing the land, and then they built this new building,
Yeah.
and I don't know how much that costs. Then to demolish this other building, like you said, all this overhead. So that's where I think they're losing a lot of money. But you're the expert, so I just wanted to.
I just know a little more than most,
Yeah,
but
so-
like I said, this right here, when the analysts do these type of things, when they start having this stuff, trust me, there's a whole lot of computers sitting in front of them, and they're doing there's a whole lot of calculations that go on. It goes way deeper than I could ever do with pen and paper or pencil and paper. But this is, like I say, a lot of the numbers that they put up are based on trends, based on what they've seen over the last year. To expect that kind of increase next quarter, 206%, that's a big increase. And if we wasn't in church, I'd have described that with a curse word. That's a big increase. You know what I mean? So so when you go, already owning SCHD or whatever you own, this is all information that you have access to help you make better decisions. If you choose to have a financial advisor, like I said, make sure that you have a financial advisor that's not trying to sell you a product, but is actually trying to educate you on what you're investing in. They're going to get their piece. That's if you choose to go with the financial advisor. They're going to get their cut. And a lot of times what's happening and why there are so many different programs out here for you to invest on your own now is because financial advisors and brokers and all of them, they were getting paid in fees and you weren't making any money. Every time they made a trade, they were taking fees. Not just this 0.06% that we were looking at earlier. No, they were taking whatever their cut was at that time. So not only were you paying that expense ratio, you were paying brokerage fees as well. All right, and some of the other stuff that we'll look at, because one of the things I want to learn, I want to learn options. So we might have to learn options together. I don't think I want to do futures. Futures is basically saying you betting that certain crops or whatever are going to do something later on down the line. Yeah, I don't want to do futures, but I think I want to learn options. You guys want to learn options? I think we should learn options. We might have to invest in some options. But did we learn enough tonight? Anybody say it's going to explode? Like I said, part of this, like I said, part of it is understanding the terminology. Which is, like I say, I wanted to make sure that you understand when you hear, if you're watching the news and they just do that, you know how like sometimes they just do that split-second financial information. This is where we're having a bullish day versus the whatever it was. So when they're talking about it being bullish and bearish, just know that bulls means it's going up, bear means it's going to sleep, it's hibernating, it's going down. Analysts will tell you to buy and hold. That's because they have certain expectations. That does not mean they're right. And that does not mean that you should buy and hold. Because sometimes I'm like, I'm not trusting you today. So you get to make those decisions. And because we have this stuff at our fingertips now, it's easier for you to take control of your money, which is a really big deal to me. Because we have left it in the hands of brokers who we were supposed to trust that have taken our money. They made millions just off of us just trading. You get to have that control now. You get to decide, you know what, I want to hold on to McDonald's for 6 months because I expected to do something and then I'm going to sell it. You can make that decision. You can decide, you know what, I'm going to buy each grandkid one share of, say like you want to buy each grandkid a share of McDonald's. If you have the money to do that, each one has a share and that's it. You just expect that share to grow up. You expect it to pay dividends, so they're going to make money on the dividends. Cash it in when you get, when you decide you need it, that if it, by the time you turn 20, you got $500, sweetie, that's on you. I gave you something to show you how your money can work for you. And that is the biggest thing. People need to understand you're not working, your money is working for you. This is another stream of income. Whether you're doing it based on growth or you're doing it based on dividends, if you're doing it based on interest. This is your money working for you. And if a lot of us had this, when we first started working, like when we had those McDonald's jobs, we would have retired way earlier than when we did. So this is, like I say, I'm such an advocate for this being part of our kids' upbringing, teaching our kids that, you know what, whether they're working or not, if you're choosing to invest for them, I'm investing in you. I am investing in you literally. Because my thing is, I want you to go out and find out God's purpose for your life, and it should not have to do with you have to go out and do this for money. You should be able to find your purpose and do it because God told you to, not because you can't do it because I have to go get a job. I have to pay my bills. I have to pay my car note. No, sweetie, you need to go find out what God has for you, and you need to be taking care of God's business. And you can do that if you're not trying to chase down a dollar. That is my thing. So that's what I got for y'all tonight. Okie doke. Is there anything you guys think you want to cover next week? Anything, like I said, when we get more into it, it's going to be some math involved. But if there's some parts that I covered tonight that you want to go more in depth about, we can do that as well. So you guys can tell me anything. AJ, anything you think we should cover next week? That is,
Google search for McDonald's stock.
yes.
It's at $2.15 a share.
Okay, yeah. Scroll up a little bit. No, scroll up. Right there. Stop going so far. I want the numbers right there. There you go. Okay. So the market cap, that's something that wasn't on the Yahoo one. But the market cap, that's telling you that's as much as we're gonna do. We ain't doing no more. So they're capping it at this. There is 160.93 billion. All right. Like I said, we already know the 52-week high and 52-week low. So when we saw that they were paying $1.29 in dividends, that is a dividend yield of 2.39%. Because based on it being $200 and something a share at some point. Okay? So it's 2.39%. And that's how they come up with that $1.19 or $1.29 that they're paying now.
Inside McDonald's reckoning on race and then loss.
So see, McDonald's is being sued. And that could be a factor in whether the price goes up or down. But does anybody think McDonald's is going to lose any sleep over it? That's the thing. So even if their stock price drops because of a lawsuit, oh, I would be all over that. Let me see when it hits its low, go out and buy your shares and then wait for it to come back. So, like I said, start reading your financial news based on what you decide to invest in. Just make yourself a little better educated. So, any questions? Oh, I think we're good. Oh, thank you, Lord, for this time together. Thank you for what we have learned on tonight. Lord, open my mind to research what options are, because you know I want to invest in some options. I don't even know what they are, but we're going to find out together. And we are making some money for the kingdom, Lord. I promise you we are. We are not trying to be greedy and selfish. We're trying to share the wealth. We're trying to help people find their purpose in you and not find it in money. Let this be a tool that they use and not something that becomes their God. We know that the love of money is the root of all evil, not money itself. So Lord, help us to continue to stay humble. Let us stay blessed, increase our finances 100-fold, that we can find the dollars that we need to invest so that we can go out into the highways and the hedges and pick some folks up and not have to depend on an offering all the time. We can do it out of our pockets if we need to. Lord, I give you all the praise, honor, and glory in Jesus' mighty name. Amen. There you go.